Imagine this. You buy a stock today, and every few months money quietly drops into your account without you lifting a finger. That's the magic of dividend stocks. On the other hand, some stocks don't pay you now, but they keep growing bigger and bigger, making you richer in the future. The big question is, which one is better for you? Today, we're going to explore dividend stocks versus growth stocks in the simplest way possible. When we talk about investing, most beginners feel confused about where to put their money. Should they choose stocks that pay them cash regularly, or should they pick stocks that grow in value over time? Both options sound good, but they work in very different ways. In this video, I'll explain them like a story so you'll understand clearly. By the end, you'll know which type of stock might fit your life better. Let's start with dividend stocks. Think of them like a fruit tree in your backyard. You plant it once, and every season, it gives you fruits that you can eat or sell. Dividend stocks work the same way. They pay you a part of the company's profits regularly. It feels good because you see real money coming in without selling your stock. Now let's talk about growth stocks. These are like a young tree that doesn't give you fruits right away. Instead, it keeps growing taller and stronger every year. One day, that tree can become so big that it's worth a fortune. Growth stocks don't pay you now, but they can increase in value so much that you make huge profits later. Here's the big difference. Dividend stocks give you steady income today, while growth stocks promise bigger rewards in the future. If you like to see cash flowing into your account regularly, dividends are for you. But if you're patient and willing to wait, growth stocks can make you much wealthier in the long run. Both have their strengths, and that's why smart investors often mix them. It's like having both a money tree and a fast-growing tree in your garden. Think of dividend stocks like a job that pays you every month. Even if the paycheck is small, it gives you peace of mind. Retirees especially love dividend stocks because they need regular income to cover expenses. It's almost like getting rent money without owning a house. That steady flow of cash feels comforting in uncertain times. Growth stocks, on the other hand, are like starting a business that doesn't pay you right away. You invest your time and money today, but the real rewards come years later. Companies like Amazon and Tesla didn't pay dividends for a long time, yet their stock values kept rising. Investors who waited patiently became extremely wealthy. That's the power of growth stocks. Delayed gratification leading to massive results. So which type of stock fits your personality? If you like security and visible cash flow, dividends feel perfect. But if you're more of a dreamer who believes in the future, growth stocks might excite you more. Many young investors lean toward growth because they have time to wait. Meanwhile, older investors prefer dividends because they want stability now. Here's a question for you. Would you rather have $500 every few months or wait 10 years to potentially turn your money into $50,000? This is the real choice between dividend and growth investing. Neither is wrong. It depends on your goals and patience. Some people love the feeling of extra cash in their pocket today. Others dream of big wealth tomorrow, even if it means waiting. Dividend stocks usually belong to stable, mature companies like Coca-Cola or Johnson & Johnson. These businesses have been around for decades and generate steady profits. They don't grow explosively, but they reward investors with regular payments. Growth stocks, on the other hand, are often in technology, healthcare, or innovative sectors. They focus on expanding rapidly instead of sharing profits right now. Another way to think about it is this. Dividend stocks are like getting pocket money, while growth stocks are like saving up for a big future purchase. With dividends, you enjoy small rewards along the way. With growth, you sacrifice now, but aim for a jackpot later. Both approaches teach different lessons about money. The key is knowing what matters more to you, comfort today or wealth tomorrow. Dividend investors often reinvest the money they receive back into more stocks. This creates a snowball effect where your income grows bigger over time. For example, you might get $100 in dividends this year, and next year it becomes $120, and so on. Over many years, this can turn into a powerful income stream. It's like planting the fruits back into the soil to grow more trees. Growth investors, however, don't focus on cash today. They look at the company's future potential and ask, will this business become huge in 5 or 10 years? If the answer is yes, they're willing to hold the stock without getting dividends. The reward comes when the stock price skyrockets, and they sell at a massive profit. It's a long game of patience and vision. One risk with dividend stocks is that companies can reduce or stop payments if their profits fall. Imagine relying on that money, and suddenly it disappears. That's why it's important to choose strong, stable companies. Growth stocks also carry risk because not every company becomes successful. Sometimes you wait years, and the stock never takes off. That's why smart investors don't put all their eggs in one basket. They build a mix of dividend and growth stocks. The dividends give them cash today, while growth stocks build wealth for tomorrow. This way, they enjoy the best of both worlds. It's like eating some fruits now while saving the seeds to grow a giant orchard later. One of the biggest differences between dividend and growth stocks is risk. Dividend stocks usually belong to big established companies that are less risky. Growth stocks often belong to younger companies that are expanding fast, which means higher risk, but also higher reward. If you want stability, dividends may be better. If you want excitement and faster growth, growth stocks could be your path. Think of dividend stocks as a safe car that gives you a smooth ride. You may not go super fast, but you'll reach your destination comfortably. Growth stocks are like a sports car. They're fast, thrilling, but also come with risks. One sharp turn can either make you fly ahead or crash. Which ride do you want to take? Here's another thing to consider: taxes. In the US, dividends are often taxed, which means the money you get is not completely yours. Growth stocks, on the other hand, only get taxed when you sell them for a profit. That can be an advantage if you plan to hold them for a long time. So, tax rules also play a role in which one suits you better. Some investors actually combine both. They hold dividend stocks for steady income and growth stocks for wealth building. This way, they get the best of both worlds. You don't always have to pick one over the other. A balanced portfolio can give you stability and excitement together. Before deciding, think about your financial goals. Do you want extra cash flow today to cover bills? Or are you okay waiting for years to build wealth in the future? Your age, lifestyle, and comfort with risk all matter here. There's no one-size-fits-all answer. The best choice is the one that matches your personal situation. Let's do some numbers. Imagine you invest $10,000 in a dividend stock paying 5% annually. That means you get $500 every year just from dividends. If you reinvest this $500 back into the stock, next year your dividends might increase to $525. Over time, this compounding effect can grow your income substantially. It's like planting a tree that keeps giving more fruit every year. Now let's see growth stocks. Suppose you invest the same $10,000 in a company that grows 15% per year. After 1 year, your investment becomes $11,500. After 5 years, it grows to over $20,000. You don't get cash now, but your wealth almost doubles without touching the investment. That's the magic of growth stocks compounding over time. Here's a side-by-side view. Dividend stock gives $500 every year, slowly increasing. Growth stock grows your $10,000 to $20,000 in 5 years, but no cash now. Dividends provide security, growth stocks provide excitement and bigger potential. Many investors choose a mix to enjoy steady cash and long-term growth. It's all about balancing what you need today and what you want tomorrow. Let's look at a practical example. Sarah invests $5,000 in dividend stocks paying 4% and $5,000 in growth stocks growing 12% per year. After 1 year, she gets $200 from dividends and her growth stock becomes $5,600. She enjoys $200 cash now and $600 potential gain in growth. Over 10 years, dividends add up to $2,500 and growth stock grows to nearly $15,000. That's why mixing both types can create powerful results. Remember, investing is personal. Your age, risk tolerance, and goals decide the mix. Don't follow someone else blindly. Create your own strategy. Use dividends for security, growth stocks for wealth building. Over time, this balance can make your money work hard while keeping you comfortable. So, now you know the difference between dividend and growth stocks. Which path fits your goals? Steady income or long-term wealth? Try mixing both to enjoy cash today and growth tomorrow. If you liked this guide, hit subscribe and don't miss our next video where we'll show real-life examples of investors making $1,000 a month passively. Remember, smart choices today can change your financial future.